The market is currently closed, but as of the last trading session, Trump Media and Technology Group Corp., trading under the ticker DJT, sits at exactly 11.54 US dollars. The stock saw a movement of plus $0.47, translating to a 4.25% gain for the day. When you see a number like that on a screen, the immediate instinct is to look for a headline or a singular event that triggered the jump. You expect to find a breaking news story about a regulatory win or a massive influx of new users to the Truth Social platform. That is the expectation. You see green, so you assume growth. But the reality is far more complex and, frankly, much more interesting for anyone who takes market mechanics seriously. The reality is that this price action likely has less to do with the fundamental business of a social media company and everything to do with the unique, almost magnetic volatility that attracts a very specific type of capital. This isn't just about a media company. It is about a trading vehicle that has decoupled from traditional valuation metrics in a way that forces us to rewrite the rulebook on how we analyze sentiment-driven assets. Most people look at DJT and see a political proxy. They see a way to vote with their wallet or a way to bet on the political future of Donald Trump. That is the common ground, the general consensus that you will hear if you ask a random person on the street or even a casual observer on a forum. It makes sense on the surface. The company is inextricably linked to its majority shareholder. However, if we peel back the layers and look at the order flow, the volume profile, and the options chain, a different picture emerges. This stock has morphed into a battleground for algorithmic liquidity and high-frequency trading strategies that thrive on the wideness of the bid-ask spread and the sheer emotional intensity of the retail base. The counterintuitive take here is that the political news cycle matters less today than the technical levels established by day traders who don't care about politics at all. They care about volatility. They care about the fact that this stock moves fast, and that is where the opportunity lies. Let's look at the recent movement. Closing at $11.54 after a 4.25% rise is a classic technical bounce. The stock has been beaten down significantly from its highs, and when you see a sudden pop like this without a major fundamental catalyst, it often signals short covering. Traders who bet against the stock are buying it back to lock in profits, and that buying pressure pushes the price up. It creates a temporary floor. You have to understand that for a stock like this, the daily swings are the product. If you are holding Tesla stock, you are used to volatility, sure, but Tesla has factories, cars on the road, and energy grids. The volatility there is usually tied to production numbers or Elon Musk's latest announcement. With DJT, the volatility is the asset itself. It is a pure sentiment gauge. The volume we are seeing is also telling. It is not just the die-hard supporters buying and holding in their individual brokerage accounts. We are seeing rapid turnover. This suggests that a lot of the action is coming from short-term speculative traders using platforms like Robinhood. The Robinhood app interface is designed for quick execution, and for a stock that moves 4 or 5% in a single session, it attracts the momentum crowd. These aren't necessarily long-term investors looking for a dividend. They are people looking to catch a falling knife or ride a dead cat bounce. And it's not just them. You have sophisticated quantitative funds involved now too. These funds use complex algorithms to snipe inefficiencies in the price. They don't care if the company makes a profit in 2026. They care if the price at 10 a.m. is statistically likely to be higher or lower than the price at 10:05 a.m. We also need to talk about the broader market environment. When you look at the tech sector, you usually look at the giants. Apple stock is the gold standard for stability and cash flow. It's the kind of stock that anchors a Schwab Intelligent Portfolios allocation or a Fidelity wealth management plan. It's boring in the best way possible. DJT is the antithesis of that. It is speculative, high risk, and high reward if you time it right, but devastating if you don't. It behaves more like a leveraged ETF or a cryptocurrency than a traditional equity. The correlation between DJT and the broader S&P 500 is often non-existent or even negative. When the rest of the market zigs, DJT often zags. This makes it a fascinating, albeit dangerous tool for hedging if you know what you're doing. The involvement of retail investors cannot be overstated here. Platforms like SoFi Invest and Fidelity Trading Platform have democratized access to these kinds of trades. 10 years ago, a stock like this might have traded on the pink sheets with very little visibility. Today, it's front and center. You have people discussing it on social media, analyzing charts, and sharing screenshots of their positions. This creates a feedback loop. If a popular forum decides that $11 is the support level, enough people might buy at $11 to make it the support level. It's a self-fulfilling prophecy. We saw this with other meme stocks, and DJT has inherited some of that DNA. The difference is the political overlay, which adds an emotional component that you don't find anywhere else. Now let's look at the company itself. Trump Media and Technology Group is the parent company of Truth Social. The business model is theoretically simple. It's a social media platform that aims to provide an alternative to the mainstream giants. They want to monetize through advertising and potentially subscription services like TMT Plus, a streaming initiative. However, the financials have been a point of contention. The company has burned through cash, and revenue growth has been a challenge. Building a social media network from scratch is incredibly expensive. You need servers, engineers, content moderation, and legal teams. It's a capital-intensive beast. The challenge they face is the network effect. Platforms like X, formerly Twitter, or Facebook have billions of users. Truth Social has a fraction of that. Advertisers want eyeballs. They want scale. If you're a major brand, you're going to put your ad dollars where the most people are. That is just basic economics. So TMTG has to fight an uphill battle to convince advertisers that their audience is valuable enough to justify the spend. This is why the price stock often feels disconnected from the business performance. If you value DJT strictly on a price-to-sales ratio compared to something like Meta or Google, the math wouldn't hold up. You're paying a premium for the brand, the figurehead, and the potential that it could disrupt the media landscape. This disconnect is why you see such a disparity in how different brokerages handle the stock. A conservative Fidelity mutual funds manager might stay miles away from this name because it doesn't fit their risk parameters. It's too volatile. It's too unpredictable. On the other hand, a high-risk trader using Interactive Brokers stock trading tools might love it. Interactive Brokers is known for catering to professional traders who need advanced order types and low margin rates. For them, DJT is a playground. The borrowing cost to short the stock can be astronomical, which leads to short squeezes. A short squeeze happens when too many people bet against the stock, and then a piece of good news or a sudden buying wave forces them to buy the stock back to cover their losses. This buying begets more buying, and the price rockets up. We have seen this happen with DJT in the past, and it is always a possibility as long as the short interest remains high. I want to pause here and ask you a question. It's easy to get lost in the charts and the noise. Comment below how many shares of DJT you currently hold, or if you are watching from the sidelines. I'm curious to see what the average position size is for the people watching this analysis. It helps us understand the sentiment better. Moving back to the analysis, we have to consider the regulatory angle. Being a public company means you're under the microscope of the SEC. You have filing requirements. You have transparency rules. Every quarter, the company has to open its books and show the world how much money it made or lost. This transparency can be brutal. If the numbers don't match the narrative, the stock gets punished. We saw this with the earnings reports throughout 2024 and into 2025. The market is unforgiving. It demands growth. If you are not growing your user base, investors get nervous. They start to wonder if the peak has already passed. There's also the technology aspect. Building a streaming service, which is part of the long-term vision, is not easy. You're competing with Netflix, Disney, and YouTube. These companies spend billions on content and infrastructure. Can TMTG compete with that? The expectation from the bulls is that the loyal user base will consume whatever content is put in front of them. The reality is that quality matters. People have limited time. If the streaming service doesn't offer compelling content, they won't watch. And if they don't watch, the subscription revenue doesn't materialize. This is the execution risk that hangs over the stock. It's one thing to have a vision, it's another to execute it. Let's talk about the future outlook. Where does this stock go from here? At $11.54, it's in a critical zone. If it breaks below $10, psychological support crumbles. $10 is a round number. Humans like